So we're going to talk about market type. And I think market type, we haven't been talking that much about market type. It's not covered often in our technical workshops, but market type is really critical. So to me, trading is a statistical issue problem. You know, if you want to know how, if you understand sampling theory, for example, if you want to know how Republicans think, you have to sample Republicans. You know, if you go to South Chicago and call up 300 people and you want to know how Republicans think, you probably don't have any information. Similarly, there's a minimum of 6 different market types: bull, bear, sideways, under quiet and volatile conditions, and the various combinations of those. So the 6 different market types are probably as different from each other as Republicans, Democrats, Libertarians, Independents, and Tea Party members.
Just a quick question on the second point. Do you have any opinion on is 6 enough? Should it be 20?
Well, I measured 25 in the newsletter, and I don't know.
In your experience, what do you generally find you use?
It tends to be an intuitive decision about what's going on. So when I know a difference between strong bear and bear versus neutral, you know, I can see the progression, and it's easier for me to get a perception of what's going on, all of which is probably an illusion. It all depends on how you want to create your reality. So if you want to know, if you want to understand the different market types, you've got to ask the right questions. It's not about prediction, it's about sampling. So is your sampling correct? Are you trying to sample Republicans? Or are you sampling the right thing? And what you're talking about is when you're collecting your R multiples for your system, are you sampling all the market types, or are you just sampling one market type and then assuming your system's going to work in all of them? So if you have a trend following system, how will it perform in down markets, in sideways markets? In each parsable market type, you need to ask yourself those questions. We recently, so I watched the S&P go from strong bull quiet to bull quiet to neutral quiet. And even in the neutral quiet, it was hitting all-time highs. But, you know, I'm kind of looking at how can it be neutral and hitting all-time highs? But if you look, it hadn't moved much. It's slightly uptrend, but not moving much. Now, that happened in 2000. That happened in 2007. And that makes you say, oh, well, maybe you can predict. When you get this kind of thing, you can predict and know you're going to have a huge bear market that might be around the corner. But then again, that doesn't say the number of times that it goes from quiet, sideways, back into bull, which it did again this time. So it's now quiet bull. So, and you also, there's so many different ways to measure market type. So if you look at this, I came up with the idea of we have to have market type. Ken liked that idea. So, but he has a whole different definition of market type. He said institutional money pays attention to the 200-day moving average. So Ken defines market type as to whether or not the markets are above or below the 200-day moving average, with a 2% band around that as being sideways. That definition is totally different from the one I have. Mine is is the S&P 500 up, down, or sideways within a specified time period. And the way I originally measured it was to look at, say, 6 months of data and say, just look at it and say, is it up, down, or sideways? Is it up or down? If it's up, if it's obviously up, it's bull. If it's obviously down, it's bear. If you can't tell, it's sideways. If it's pretty indeterminate, then it's sideways. I wanted to measure it, so then we developed other ways to measure it. I use the SQN, but I'm going to recommend for most of you that you use the range change. But these are two totally different beliefs. They're not the same at all in terms of measuring market type. So here's the 6 market types. Now, as I said, I typically use the SQN 100 score, but it's proprietary. I'm going to teach you something really simple. And the only difference between this and what you do is the SQN is basically a t-test, and it says, is this thing significantly different from 0? So if you have an SQN of, say, a plus 1.6, certainly with 100 data points or even 25, you can say, yeah, it's significantly different. So I typically call plus 1.6 getting to the strong bull side, and the minus 1.6 is the strong bear side. But you don't need that. You could just use the range. Look at the range over the range percentage change over the last 100 days or the last 25 days or whatever that happens to be. Or what is the, I don't know why I said 500%, but that's an error in the slide. It should be 100%. Anyway, greater than 5% could be bullish. Between 5 and minus 5 is neutral, and less than 5% is bearish. So the thing is about that one that makes it really interesting is no matter what kind of trader you are, you can use it for any time period you want. So I'm using daily bar or daily percent changes with the S&P 500, but you could use as your range hourly bars or 5-minute bars. You could have 100. If you're a day trader, 100 5-minute bars would be a good market type. Or even 100 hourly bars would be a good market type. So days, hours, 5-minute bars. And you'd probably need at least 5,000 data points to determine what's bullish, sideways, down for that time period. We have data from, on the S&P, daily data from about 1950 to the present, so about 64 years. Now this is really important because this is not a predictor. You can't predict what will happen tomorrow in terms of what the market type will be. Is it going to change from one to another or something else? That's like saying, will the trend continue? You know, and then it whipsaws down. You say, oh, it's not continuing, and then that turned out just to be a reaction, and it goes back up. And you can find systems that will perform well in each market type. But the key thing here, what everybody needs to understand, is that and we actually focus our systems workshop on this now, this whole concept of it's easy to design a really good system, even a holy grail system for any one market type, and it's insane to expect it to work in all market types. So look at all those people in 1999 who were about to retire because of all the money they made on the stock market. They thought they were absolute geniuses. I know one guy who did retire, then had to go back to work 2 years later. We had waiters at the restaurant saying, well, I'm only a part-time waiter, I'm really a day trader, or I'm really a trader. We gave around that time, we were giving workshops at the Embassy Suites. They had a happy hour, and the two bartenders, we were giving a stock market workshop. The two bartenders said, maybe we should attend Van's workshop. And the other one said, no, I could teach that. Okay, so, and all it is was, it's pretty easy to make money in a, well, that was a strong bull volatile market in those days. So for each market type, you have different beliefs, depending on how sophisticated you are, and you need to know what those beliefs are. You know, so one of the things I'd always recommend you do is take each market type and write down all your beliefs about it. And you can use those beliefs to design a decent system. And it's, as I said, that's a primary focus of what we do in the systems workshop. In addition, we now have a bear workshop, and RJ's working on a sideways workshop, and we'll probably do a bull workshop after that. About the time we get to a strong bear market, we'll develop the bull workshop. But we figure that's the easiest one to trade, so. And sideways is probably the hardest. So let's look at percent range change data for the S&P 500. So this is based on data from early 1950s until the present. So if you look at the 100-day range change as a percent, so you've got to use it as a percentage of the price at the beginning. So strong bull, when I called it strong bull with my other market type, the range change percentage was about 15% with a standard deviation of 5.4. When I called it bull, the range change percent was 8.23 with a standard deviation of about 3.5. When I called it neutral, and I have neutral as being slightly positive because the market can switch on a dime, and when it's getting down there, especially if it's coming down fast, I want to know. I get nervous at this period when there's not much range. When it's slightly up and there's not much range change, I want to know because it might be heading into a bearish camp. In 1987, you had exactly 1 day of neutral before the crash that you could have taken action on, before the 20% down day. Range change bear, minus 3.92, and strong bear, minus 12%. So this is for the S&P 500. If you took, so we have, at least the time I did this chart, we had almost 16,000 days. The average 100-day range change is 3.34%. So if the market's up 3.34%, that's average for 100 days. But the standard deviation is 9.6, and the maximum is almost 46%, and the minimum is minus 41%. So that means they're in the last, since 1950, you've seen the S&P move by as much as 46% in 100 days up, and by 41% in 100 days down. Oops. How did it get out of that? I don't even know which one I was on. This is your review. So if you wanted to do, say, a range change, the 100-day range change as your market type, a strong bull would be plus 13% or greater than 13%. Bull would be 13% to plus or minus, say, 3.3%. bear would be less than 3.1%, or minus 3.1% to minus 13. Strong bear would be minus 13. And what I missed was, in that, which was the question, was how do you do volatility? There are actually, so all I do is take the 20-day average true range. And I take the 20-day, for each 20 days, over almost 16,000 days, I have the average true range. And the mean of that is about 1.7, I think, something like that. And it's interesting because at one point we had data for 30 days or for 30 years, and then at another point we had data for 60, and it didn't change. So, 1.7%. 1.7, I think it's the 20-day ATR. And RJ, do you remember what the numbers are on the?
It's the ATR percentage, right?
Yeah, it's the ATR percent. You can't do the ATR, just the ATR. You have to do an ATR as a percentage of the close. Otherwise, we've been in volatile markets for the last 30 years, or 20 years. And the previous time, it was all quiet.
That's a question while we're waiting.
Sure.
The granularity in terms of market type. So if you have a market type for the S&P and you're trading a stock that is in the S&P or is close enough, you could potentially use the S&P to define market type. What's your opinion when you start to venture quite a ways away? Like, let's take the Nikkei or copper, or even worse.
Probably you need your own market type.
It's
So,
specific to
you
that
know,
market.
what I do every month is I write that world model, and there's an ETF representing all those different things, and that is the SQM 100 score. So, you know, when you look at the different things, you'll see things that range from potentially +4 to, you know, maybe -3 or something like that in the whole range, and that could be in 1 month. So there's certainly different market types going on in different things. Generally, for the New York Stock Exchange, the S&P is a pretty good guideline of what's going on, and maybe it's probably okay for the NASDAQ, but you do have some things that are in the NASDAQ that aren't in the S&P, so the S&P could be neutral while the NASDAQ is bullish or bearish or something like that. Certainly microcaps would fall into a different market type than the big stocks.
What would you say if somebody wanted, I'm not saying that I would do this or I know anybody that does this, but if you're trading a stock, IBM, I would say, like I think you just did, that the S&P is a good enough proxy for market type. But what if somebody came back and said, well, I want to have the market type for IBM? See what I mean? Like
If you're only going to trade one stock, you might as well have a market type for that one stock. If you're only going to trade a small universe, you could put some weighted average of that small universe of stocks and use that as your market type.
People do that in currency pairs.
yeah.
Or even bond futures. That's a 10-year.
So while RJ's looking up,
It's 1.29 is the mean.
oh, it's 1 point, okay, so here's the Denvers. 1.29 is the mean.
And the standard deviation is 0.71.
That's where I got the 0.71. And what are my numbers?
Half the standard deviation on the positive side is volatile. Very volatile starts at 3 standard deviations. Quiet is negative 0.5 standard deviations.
Wait a minute, +3 standard deviations equals very volatile. And what?
Quiet is less or a negative half standard deviation.
Symmetrical, right? Yeah.
You never see any very quiet. And then normal is between minus half and plus half. Kim, it's very asymmetrical. Very volatile, way off, but you never get very.
What happened? And if you look at the distribution of this chart, it's not normal by any stretch of the imagination. It looks like so very volatile comes in like here. But it becomes significant enough. I remember in 2002, which was a bear market, so a little bit more volatile than normal, I developed this mutual fund system. And my definition of volatility at the time was normal volatility seemed to be that the S&P went up about 2% a week. So I had parameters around the S&P moving 2% a week. And then 2003 came along, we went into a bull market. And yeah, I think we maybe saw 2 weeks, 3 weeks in the whole year when the S&P moved as much as 2%. In that kind of bull market environment. And then it moved 3 or 4 years, and it got up to where we were occasionally, maybe 1 week in 4 was 2% or more. And CNBC actually called me up. They never called me up, but they actually called me up, and somebody wanted to talk to me as a psychologist about how traders were handling this high volatility. They didn't bother to call me up in 2008 when there was real high volatility. And I just sent them an email that said, hey, look, this isn't even close to what we were having in 2002, and you're asking me about how they're handling high volatility. And which brings us to an interesting point, because the way Ken handles volatility is he handles high volatility with a 100-day range. So he'll calculate, I guess, is it 20 days? Yeah, so he'll calculate the 20-day volatility, but he's ranking the volatility now with compared to how it's ranked over the last 100 days. So it can be high or low compared to the last 100 days, which he thinks is useful for him in his day trading, but it doesn't really tell you anything. So he could say, oh, volatility is really high, but he's meaning related to the last 100 days, whereas when I say it's high, it's high, and it has some meaning within the framework of high. And for a long time, right now we've had this volatility that's quiet, so it's less than 1 standard deviation. That means it's less than 1 standard deviation below the norm for the last 60 years. So it puts in perspective what we're dealing with. And one thing that I'm pretty happy with in terms of a predictor is the market's not going to get very bearish when it's quiet. Bull quiet is a very, very rare entity, and if you have any suspicion at all that it's going to get worse, and you got bull quiet, your best bet at all is to buy volatility.
Bear quiet.
And bear quiet, because if it's going to continue, it's going to get really volatile. That happened in 2011, I think. I bought the VIX ETF because it got to bear and it was still bear quiet, and it looked like the bear was going to continue, and they'll start into an up move, and so I bought the VIX, and it went up 20 or 30%, which was a nice move. But I think if there's any predictability at all to market type, it's if the market is quiet, not even normal, but quiet, you don't have a lot to worry about yet in terms of suddenly it becoming bearish. A surprise event might begin to turn it into higher volatility. It might be enough to move it up into normal. And then if there's some continuation, then I'd be worried about it. But I think you're pretty safe as not having a bear market if the volatility is quiet. Because bear quiet is a very, very rare animal in terms of market time. Bear normal, maybe, okay, but bear quiet doesn't happen. So that's not a prediction, that's just a probability statement.